Welcome, everybody. This is a day trading options daily review for May 26, 2016. You heard that correctly. This is actually the second video we've done on trades this day, and it is the second video that has less than stellar results because it's quite possible to get in and lose money in the options. And we like to show you the 10% in 10 minutes, but every once in a while we like to show you in a little more detail things that maybe were clues that this trade wouldn't go well, or some more in-depth discussions of trades that aren't making money, because oftentimes we learn more from our mistakes than we do from our successes. In fact, oftentimes if you get into something like trading stock options and you're very, very successful very, very quickly, you think that maybe you're a genius and your ego gets out of control, and the next thing you know, the market gives you a nice little slap and you lose hundreds of thousands of dollars, like we talked about in the last review. So I'm Scott, he's Alan. Make sure you click the little bottom subscribe button in the descriptions. We've got our courses and a little bit of a discount for you. We want you to learn how to do this. Then we want you to get the free trial and practice. And then we want you to upgrade to the not free live version and trade successfully. And it's a process. We're here for the long haul, and we expect you to be here for the long haul as well. So Alan, let's talk about Goog on May 26th.
I'm not sure that the times that are given here are right, because sometimes people write down the time from another, like their time zone, not the market time. But I'm going to presume that this was done at the market time. And so this trader asked us to do a review, which is why we're doing it. And they got in somewhere around halfway through that candle. Now, I do have K-band turned on. And yes, it crossed the mag line, but it's inside the risk zone. The market is moving up, which is good. But this is why I'm thinking maybe I got the wrong times, because I don't have the K-band tint in the background. We're inside the risk zone, which is, here. That I understand sometimes people do, trade that. But there's nothing here that tells me that this is a great trade, other than, yes, it's above the benchmark and it's a green candle. But beyond that, I don't see this as a trade. Now, I'm using the 4-minute candles. If I switch to 5-minute candles, I don't think it's going to be really much different. So Control 5 changes it to 5. I mean, as you can see, it hasn't really changed much. It's still...
And you actually had the K-band going the other way a few minutes earlier.
Yeah, so before and after... of course, and that's the thing about the mag line, is it tries to be consistent across whatever times you choose. So it didn't change, it's just barely crossed. And so in this minute, while it was pulling down, I understand, yeah, you might have got into that. But I don't see, this is a reversal trade thinking. And I deliberately don't teach reversal trading, because in that other video we did for today, that the fellow that has done well over a 10-year period, he really likes reversal trading, which is why, yes, he lost a big pile of money, because he's not so good with the trending side of life. He's good with, he likes things that come off a bottom and come off a top. And I've done lots of data-driven testing. So my testing is not about what I think and feel and hope. It's like, well, here's 20 million records in a database. I want you, computer, after I write some rules to test, to tell me how that turns out with this indicator or that indicator. It's a lot of work. Collecting the data is, only part of it, but the big job is to write all these little tests things. And ultimately, and there's lots of good books about this too, is the best money is, and most reliably, is with trend trading, because, and here comes the conversation, yes, this stock broke out of this range, and that's an okay thing to do. on a larger scale, it's not a great thing to do. There's not much going on with this stock, and Goog can be a bit of a volatile, jump around kind of stock because
Well, and if I can jump in here too,
yeah,
Alan, if you go back one more tick from where you stopped,
yep,
then it's actually hasn't broken. I mean, what I meant was when you drew the line for the trading, it was trading in a zone and marked
yep,
out. If you
yep,
go back one more to 955, all of a sudden it hasn't, right? Because actually the
yeah,
top line should be up at 726.
yeah, exactly. And so
Right.
this is where I'm trying to go with what the trader's mindset was, and great kudos to them because they know that they're still in the learning process. So this is why we're doing this for them. Is like, well, here's what I would do, and you know, lots of traders with lots of experience would do similar things. The ones that aren't as successful are the ones that like to catch the little jumping around inside a range. So let's say this is your range, and this is what I'm guessing is maybe what was in the mind here, is here's your morning range. So it's actually drawn up for you, 945 range. So from here to there. And so it's like, well, okay, it bounced off of there. So it will, no, it won't, it might run back up here, okay? Problem with cycle trading is it might just run up to here and then go here, and it's a meandering kind of thing. And that was why, for example, Einstein didn't figure out how to beat the stock market. Yes, brilliant guy, couldn't beat it because he wasn't looking at it right. That's all. So let's just move forward here and see what we can come up with. So I'm going to hit the buy button. And then this person was in this trade for quite a while, and I can understand why. You can see da-da-dee-da-dee-da-dee-da-dee-da. By the way, this is why the risk zone was created, and why it paints the way it does is it's like in here, it's just a mixed bag of whateverness, and it's not a breakout, which is why the lines are drawn for you. When it breaks out of there, you have a better chance, not a guarantee, better chance of success. And we saw one with that other review where kind of like this, it broke out and then went back in. It's like that will happen. The question is, what are you going to do? And of course, you know, just looking at this, I see RA right here, and it, you know, had trouble beating it. And this is, you know, we're using 5-minute candles. You should be using 1, 2, or 3-minute candles, you know, in this time frame, so you can see zoomed in what it's really doing. But let's go back to this trade. So here you're almost making money. So you can see how it pulls back and goes up and pulls back, and we're just going to keep going forward. And this is when they finally got out of the trade, if I have my time frames right here. And for them, because this is a Thursday, and because expiry on these options are tomorrow, you feel the time decay much higher. So in this case, it was recorded as a 15% loss on the option. And they had some comments about, well, they got in a little late and, you know, that kind of stuff, and that's okay. But because this is sideways, what happens is the bid falls off. So you got two things working against you. Is who wants to buy a call when it's channeling like this? Almost nobody. And so what happens is, although the value may be here for the option, what happens is the bid starts going here and here and here and here, but also the value starts dropping because it's Thursday. You know, the probability of this thing hitting some target price like here to be worth something starts to get smaller and smaller, so it starts to lose value. So all that stuff's quite okay. I'm just giving you the background about why it would decay. But if you really wanted to trade this, you have a Y point here, you've got a mag line that's falling. If there was any kind of trade here, and I don't like them, is if it strongly broke out of this range. then maybe there's something. So I think getting out of here was a good idea, because this is showing you, like we saw before, no love. And possibly, you know, getting out here would have been better, because this is just more time decay. The best time to have gotten out, of course, would be here when it was climbing up. It's like, woohoo. For me, I'd get out here if I did get into this trade, because it's like bouncing around doing nothing. And it's like, I can probably get out at break even. I would have got out at break even here. I'm not looking for a profit. And I've seen some people do these things where they think, you will go here. It's like, no, it won't. It'll go where it wants to. And, you know, they've had profits and they've given them up because you're going to do this. No, it's not. It's going to go do what it does, not what we want. So that's that one trade. And then the other one was Tesla. So they got out of this one and then they got into Tesla. So let me just bring that up right around the same time. And so got in here. Now this looks more like a trade we'd like to get into. But, and you know, again, kudos to them, they're learning. And they're not putting big contracts on the line and risking money. They're doing things, you know, like testing it, and maybe they used a virtual account, but even if they didn't, they only bought one contract, which is a really good way to go. And so the ideal place to get in would have been here somewhere, anywhere in this candle, right? Because you've got the tint, you've got the slope, the market at that time we could go back and look at, but they bought here. And my problem is, well, that's that. This is the first candle out of the risk zone. That's the second. This is the third. That's the fourth. That's too late. And they actually, you know, kudos again to them. They knew that, and they said, yeah, I realized I did that. So let's just see what happened. And they got out in 9 minutes later. So that's good. So let me back up to 10:42. So they got in somewhere around, price was around here. I'm just going to say that one. So, and we're going now to 10:50. 1, 2, 3, 4. So that's when they got out and they took a loss. Now, you can see that, and that was a bigger loss. They actually lost more than 10% because it was Thursday, and so you're not putting up much money. The options are cheap, so you're gaining and losing bigger percentages. Again, we keep that out of the replay because that's just like more details, where the thing that we want you to get is, this was a trade right here. This was a clue that the trade was over. There's no tint here. And, you know, this kind of stuff happens. This market line is going this way. This was stopped being purple. It went to this other color, so it's not as strong. You have mag that's dashed, lots of stuff, and volume spike was here, which is usually the beginning and or end of a move. Well, it wasn't the beginning, so it's one of those where, you know, this is low volume. You're at, you know, one of these 15-minute intervals. You know, that marks a turn in the market quite often. So everything's saying this isn't such a fabulous trade. So getting in at anything that ends in, like, for example, 10:44, 9:59, those are times I won't get into a trade, like not even 58 or 57 or 56, maybe 55, because then I've got 5 minutes before I hit the wall where things turn. See, like here, 10 o'clock, that's the end of the 10 o'clock candle right there. So then what does the market do? It does something different. Why does it do that? That's just the way it is. So here it turns at 10:30, it turns it on, boom. 10:45, it turns it off and goes the other way. These are all the things that, you know, aren't included in Einstein's idea about how the market runs. This is about human behavior, which is an important part. So in our human behavior, we look and watch for the people with money and their standard behavior, because a lot of these people with big money, not the investors, but the traders that are pushing the market around, They add a fair bit of weight during the day. They know how the patterns are, and they go, oh yeah, this thing here and that there, we're gonna just probably just get out of it. And if you're, you know, a Fibonacci trader, you know, you'd have these, you know, percentages here, maybe not. And this one, it doesn't look like much, but they use a few things like that. Fibs are not that great. They're okay, but they're not great. These things here work way better. So here the thing tried to push up to, you know, beat RA, and maybe that's what they were waiting for, was to beat RA, but getting in here was above the 945 top. I understand that. But the trade should have been here, where you're getting in before you bounce. See, like if you're going to get a bounce, I'd rather pay for the bounce nicely below when it happens if I think the trade's great. Because then if it does fail, I'm wrong. You know, the trade doesn't work out. It's not about me being wrong. The trade just is a bad trade. I'm getting out at around cost. If I get in here and it turns around, which it can do, it doesn't happen that often, but it does happen, then, and I get out here, I'm losing from here to there, whereas here I'm basically almost no loss. So getting in here, broke the risk zone, got the tint, all that kind of stuff. I've got, everything's looking good here. That was a good time to get in. Getting in here is obviously too late when we're looking backwards, but if we just go back a little bit to, because this is a 5-minute candle, it includes what happened after it, right? So here you can understand, oh, well, that looks like a good trade. But first candle is this one, second one here, third one here. You can already see that this candle, and this is what this pie chart tells us, is that 40% of this candle, almost 50%, is finished on a 5-minute time frame. I have no volume. That means the volume spike was this guy. And the market is, you know, not great. It's okay. It's overall not so fantastic. This looks still like a good trade, but it's the fourth candle. It's not the second. It's certainly not the first. So that's my opinions about what happened on that trade. And that was one of my bad habits, was to get into trades late. We all have our bad habits. There's 11 of them documented nicely in that course, the 11, you know, mindset course. But when you got 1 or 2 or 3 of them, it's your job to get rid of them. And the tools won't do that for you. And that's why we talk about, yeah, we've got great indicators, arguably some of the best in the world. But if you're getting in the wrong places or at the wrong times, the program is not going to help you with that. It's really us, and we go, oh, but that's the good news. I know what I have to focus on. I got to follow my rules and get in there. That's all I got to do. Well, why don't I do that? And so we've already posted one of the items for that new advanced course in here, but it tells you quite clearly what recipe is that I use. I used it. It's not like it's a theory. And I reviewed it with somebody who's an expert in psychology, and he says, yeah, that's actually brilliant. He says that I can see why that worked. And by the way, you know, he went on about, you know, dopamine and so forth. But maybe I'll get him as a guest. But that
sounds like a good idea, Alan. Thank you very much for sharing all of that. And hopefully you've got some insights now into getting into trades, because that's really what we're talking about a lot in this particular review. So thanks for joining us. This has been the Day Trading Options Daily Review for May 26th, our kind of Q&A session, except we got the questions from the Facebook group, and hopefully these answers are going to help you with your trading. Make sure you subscribe below in the bottom right-hand corner, and take the courses, practice, and join the Facebook group and share your trades. And we'll talk to you soon. Thanks. Bye-bye.